U.S. economy standing still since 1999. Think the U.S. economy has come a long way? Think again. And as we dig out from the rubble of the fallen financial sector of the worldwide economic crisis, it's common to hear economists worry that the U.S. may face a Japan-style lost decade. After its real estate and stock bubble burst, Japan struggled with low growth throughout the 1990s. It emerged from the decade shrunken and sapped of confidence, with very little to show for a large amount of government spending and near zero interest rates. When 2010 comes in a couple of months, it will bring down the curtain on the aughts, a period in which a great deal and not much at all happened, economically and financially speaking. In fact, a startling number of contemporary indicators are at or below the levels at which they stood 10 years ago, starting with the single most important economic number, jobs. Over the past 10 years, job creation has been extraordinarily weak. In September, on a seasonally adjusted basis, there were 108.544 million private, non-government payroll jobs in the U.S., almost precisely the number there were in June 1999. In the past decade, in other words, the private sector hasn't created a single job. That's extremely poor, especially when you consider that the U.S. population grew 9% during those years, from 282 million in the year 2000 to 308 million today. The U.S. stock market performed like somebody running on a treadmill. A lot of energy was expended to travel the tiniest or smallest of distances. Stocks went precisely nowhere in the past decade, despite all the efforts to help the market, from cutting capital gains and dividend taxes to keeping interest rates extremely low to all the bailouts. Meanwhile, Americans seem to have lost their interest in investing. Between 1992 and 2000, the percentage of households owning mutual funds doubled from 24.4% to 49%. And between 1992 and 1999, the percentage of Americans owning equities, either through mutual funds or as individual stocks, rose from 36.7% to 47.9%. According to the Securities Industries Equity Ownership in America 2008 report, the proportion of the population that owns stocks or bonds fell from 57% in 2001 to 48% in 2008. And in 2008, 45% of U.S. households owned stocks inside retirement programs and in brokerage accounts, down from 49% in 1998. Investors may have been turned off by the market's poor performance, but in this past decade, Americans didn't have much leftover cash to deploy into the stock market. Incomes were basically stagnant during the decade, while the costs of vital goods and services, education, energy, health insurance spiked. The latest report from the Census Bureau on income, poverty, and health insurance is full of interesting data, which shows that median household income in 2008 at $50,303 was below where it was in 1998. The same report shows that both the number and the percentage of people living below the poverty line rose from 11.9% in 1999 to 13.2% in 2009, standing still, falling backwards. Many factors explain the sluggish performance. Globalization, the continuing information technology revolution, and the offshoring of manufacturing and service jobs kept employment in check. But at its root, it turned out that the policies enacted, low interest rates, cutting taxes aggressively, disempowering unions, and empowering Wall Street, deregulating the financial system by the folks running the system, just didn't work as advertised. Meanwhile, policymakers neglected some important areas that can help support financial stability, like health insurance. Since 2000, a period of generally low unemployment, the portion of the population getting insurance directly from the government rose from 24.7% to 29%, while the portion receiving employment-based coverage fell from 64.2% to 58.5%. Between 1999 and 2008, of the census report, the population of the U.S. rose 9%, but the uninsured population of the U.S. rose 19.5%. There were a few areas of progress. Partisans of the decade's economic policies liked to hold up the rise in home ownership as a success. Instead of buying stocks, Americans were buying McMansions and condos. And as the census data on home ownership rates shows, the housing and mortgage bubble boosted the home ownership rate, which peaked at approximately 69% in 2006. But now it's going back down. But while stocks and bonds are bought mostly with cash, homes were purchased mostly with debt. And what leverage gives or giveth higher home ownership, lots of jobs tied to real estate, leverage taketh away. Once the housing market peaked in the summer of 2006 and foreclosures started to mount, the home ownership rate declined and is still declining. Today it stands at 67.6%, almost precisely where it was in the fall of 2000. So in other words, the U.S. economy has gone nowhere. It's made little or no progress since 1999, 10 years ago. Meanwhile, it has added more population, more people. So, again, in other words, there's going to be a lot of unemployed people, no matter what happens. And like I say, no job creation, no real economic recovery is possible. That's just the way it is. And on top of all this, there's something much, much more going on. And these are the signs of the end times, transition days. An ongoing, continuing transition is happening all around the world, day by day.